Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Nokia Corporation.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. We are discussing, I think, one of the most compelling yet, historically controversial turnaround stories happening in tech infrastructure right now.
Right. For years, the market viewed Nokia purely through that lens of its consumer phone legacy.
A company that just completely missed the smartphone wave. But that narrative has, it's fundamentally shifted.
That legacy image is proving to be a heavy anchor, though. When you talk to investors, they still associate the name with that failure.
They do.
What you're suggesting is that management has successfully executed a pivot, moving the company away from that past and into the future of high-margin AI and 5G infrastructure.
Precisely. The core thesis here is pretty simple. Nokia is no longer a traditional telecom equipment vendor. They are now selling the foundational shovels for the global AI and data center gold rush. But look, a strategic pivot only matters if you can show execution.
Right. And that's where the Q3 2025 results come in.
Exactly.
Okay, so let's ground this in some hard numbers because talk is cheap. A pivot sounds great, but where's the actual revenue shift happening?
You have to look at the network infrastructure segment. That's the real engine of the new Nokia.
In the numbers there.
Net sales hit $1.95 billion. That's a robust 28% year-over-year growth.
28%. Wow.
And that isn't growth from selling more standard mobile base stations.
Yeah.
This is growth fueled by serving hyperscale cloud providers and telecoms.
The ones upgrading their backbones to handle all this new data flow.
All driven by AI demand, yeah.
That 28% growth is very eye-catching, but I also see the Nokia technology segment contributing. That brought in $391 million, up 14% at constant currency.
It did.
Why does that diversification matter for the core thesis?
Well, it matters because it shows their intellectual property portfolio is highly relevant in next-gen industries.
So not just telecoms.
Not at all. That segment includes licensing revenues from consumer electronics, automotive, and the Internet of Things, or IoT. All of those sectors are becoming more and more dependent on embedded intelligence, which it directly benefits from AI.
And it gives them a stable, high-margin revenue stream.
Exactly. It's kind of disconnected from the sometimes volatile carrier spending cycle.
Okay, so we have strong current results and diversified revenue streams. But this sounds like more than just incremental change. It suggests a fundamental shift in how the company operates.
Absolutely. The reorganization is key here.
The one that's effective January 1, 2026.
Right. They're streamlining operations into two main segments: network infrastructure and mobile infrastructure. This isn't just swapping names on an org chart.
It's about cutting the red tape.
It's about cutting bureaucratic overhead, unlocking efficiency, and crucially, accelerating innovation specifically in what they call AI native networks. They're structuring the company to be faster in AI.
Streamlining is good, but investors ultimately want to see profit. If the current results are the proof, then I guess the 2028 financial targets are the core of the bullish case.
They're cornerstone of the entire investment thesis. The targets are enormous.
So what are they actually promising?
Management is targeting a comparable operating profit of, get this, 2.7 to 3.2 billion by 2028.
Okay, let's put that in perspective for you. Their trailing 12 months profit base is what, around 2 billion?
Roughly, yes. 2.0 billion. So they are targeting a 35 to 60% expansion in profit in just 3 years.
60%.
This isn't just optimization. This is management betting the farm on their strategic shift.
And a profit expansion like that requires sustained, really high-speed growth in their most lucrative areas, right?
It has to. It must come from the highest margin, fastest growing divisions.
Which are?
Optical networks and IP networks. They're targeting a 10 to 12% net sales compound annual growth rate, or CAGR, from 2025 through 2028, specifically in those areas.
Let's break that down for our listeners. A 10 to 12% CAGR. What does that mean in practice?
It means they need to average double-digit sales growth every single year for the next 3 years.
In those specific divisions?
Specifically within optical and IP networks. These are the parts of the business that build that foundational digital plumbing.
Sure.
The high-speed routers, the optical transport for data centers.
So if they hit that target, it basically validates the whole story.
It validates the idea that they're winning market share in the most profitable parts of the AI build-out.
That sounds like a highly competitive field, though. If they're growing that fast, they must have some kind of defensive mechanism, a competitive moat.
What's fascinating here is their focus on end-to-end architecture.
Okay.
They're not just selling a single component, they're offering a full-stack integration across optical, IP, 5G, and, now AI tools.
So when a cloud provider buys in, they're buying the whole package.
The whole pre-assembled building, basically. And that creates enormous switching costs. They get locked into that single ecosystem. It makes it incredibly hard for a customer to switch to a competitor.
The complexity itself is the barrier to entry for rivals. And they aren't just relying on internal R&D for this.
Not at all. They're using strategic M&A to accelerate it.
Which brings us to a couple of really big moves.
Absolutely. First, the $2.3 billion Infinera acquisition, which closed back in April 2025. That instantly expanded their capabilities in high-capacity optical networking.
And that was aimed at the big cloud giants, right? The Amazons, the Alphabet.
Exactly. The ones who need unprecedented bandwidth for their AI farms.
But the real attention grabber, the event that truly crystallized the market's view of Nokia as an AI play, that was the partnership with NVIDIA.
That was the game changer. It's a profound technology moat. NVIDIA made a $1 billion investment for a 2.9% stake.
And it's not just a financial transaction.
No, it's a deep technical integration. NVIDIA is essentially choosing Nokia as their preferred partner to build the physical network layer for the next generation of AI.
Let's break down that term you used earlier, AI RAN. What exactly are they building together?
AI RAN stands for AI Radio Access Network. In simple terms, traditional mobile networks are. They're fine for general data, voice, video, that kind of thing.
But AI is different.
Totally different. AI processing needs a network that's optimized for constant, high-speed, low-latency data transfer. By integrating their RAN portfolio with NVIDIA's AI platforms, they're creating a network built from the ground up for AI.
Which makes them a preferred vendor for what? Building out AI-native 6G networks.
That's the key differentiator. And it validates their entire strategic shift. That stamp of approval from a trillion-dollar company like NVIDIA is huge.
Okay, so that's the growth side. Let's talk about the other side of margin expansion.
Yep.
Cost discipline.
Yes, that's essential for bridging that gap. They're targeting a substantial 57% reduction in their group common and other operating expenses.
57%. What's that in real money?
It's about cutting $200 million from the current $350 million run rate by 2028. And every euro saved there goes straight to the bottom line.
And when you combine that cost control with the huge profit targets, the story becomes about cash flow.
Absolutely. It's all about cash flow. The company targets a high 50 to 80% free cash flow, or FCF, conversion from their operating profit.
So if they hit the high end of that 2028 target,
that $3.2 billion, it could translate into 1.35 to 2.56 billion in annual free cash flow.
that kind of cash generation completely changes the financial profile of the company.
Completely. It's the fuel for future growth, paying down debt, and shareholder returns.
Okay, let's shift focus to how the market has reacted. It sounds like institutional investors are already buying into this vision.
Oh, the technical momentum is unmistakable. The stock has demonstrated really strong bullish action, soaring 50% year-to-date in 2025.
And up 34% over the past year. This looks like a serious breakout.
It really does. It suggests that institutional money is finally recognizing the value of this pivot.
And the immediate catalyst that drove that shift was clearly the NVIDIA news.
That was the signal. The share price surged, 20 to 23% on extremely high volume. That kind of breakout often signals the start of a new institutional accumulation phase.
And we're seeing more evidence of that, right? Institutions increasing their stakes.
Yes, and when you combine that active accumulation with NVIDIA's own strategic investment, it really does look like a cluster buy signal. Sophisticated capital is validating this story.
So looking ahead, what's the next big inflection point for investors?
January 29, 2026.
That's the Q4 and full year 2025 earnings release. Why is that specific date so critical?
It's the first real opportunity for management to confirm or maybe even revise the roadmap toward that 2028 guidance.
The market will be laser focused on whether they're still on track.
Exactly. Any deviation from that path to 3.2 billion in profit will heavily influence the stock's direction for the rest of 2026.
And beyond the big earnings report, we should also be watching for smaller operational wins.
For sure. In Q1 2026, we need to see more major 5G contracts like that deal with Telefonica Germany. But more importantly, look for specific announcements on new AI RAN developments with NVIDIA.
The public proof points.
Those are the proof points that the strategy is translating into real business.
Okay, we spent a lot of time on the really compelling bullish case, but we have to talk about the catch. The current valuation, it's sobering.
It is.
Some analyses suggest the stock could be overvalued by over 177% based on near-term figures. That is an enormous hurdle.
That is the single biggest risk, and it's a valid concern. When you see a stock trading that high relative to current fundamentals, it means the market has already priced in the success of the turnaround.
It's not cheap.
Right. By any means.
So how do you rationalize that? How do you mitigate 177% overvaluation risk?
You have to accept that the bullish case is entirely dependent on management executing those 2028 targets flawlessly.
You're betting on the future, not the present.
Exactly. If and only if they deliver that targeted profit, that performance would dramatically compress the valuation. It would bring the PE ratio down to a much more attractive range, maybe 15 to 20 times earnings.
So for this stock, execution isn't just important.
It's the only thing that matters to justify the current price.
And we can't ignore the macro environment either. The telecom sector is notoriously cyclical.
That's right. Global telecom capex softness is a constant risk. If there's a severe macro slowdown, carriers could delay 5G or 6G spending, which would be a severe drag on their growth.
We've also got things like currency headwinds.
Yeah, a weaker U.S. dollar, for instance, reduced their 2025 profit forecast by a substantial $310 million. These are real external pressures.
So does the AI focus insulate them enough from that volatility?
It should. And that's the crucial counterpoint. The demand from the AI supercycle, particularly that targeted 10-12% growth in data center networking,
Right.
that's far less cyclical.
Because the cloud providers have to build out capacity.
They have to. That massive non-cyclical demand should offset some of the weakness in traditional telecom spending.
We should also briefly mention the IP risks.
Right. They have a huge portfolio, which makes them a target for ongoing litigation, like the recent Paramount patent dispute. It's just part of the operating environment for them.
So let's bring it all back to the core idea. What does this all mean for you, if you're interested?
Look, the company has fundamentally shifted its focus. They are betting their entire future on becoming the key infrastructure partner for the AI-native 5G and 6G world.
They've secured a powerful ally in NVIDIA, made a game-changing acquisition in Infinera.
And they've initiated an aggressive cost-cutting plan.
So the multi-year upside potential is substantial, but it's entirely conditional. It all hinges on hitting those aggressive 2028 profit targets.
Right. So the key question for you to consider then is this. Do you believe the structural long-term demand from the emerging AI supercycle is strong enough to overcome the historical volatility and execution risk of the traditional telecom carrier market?
And that's where the long-term conviction truly lies.
That's it.
That's all the time we have for today's analysis. If you found this useful and want more concise analysis like this, remember to subscribe and leave us a comment. We'll be back tomorrow with more Smart Wealth with Joshua.